All right. So then we start right away, ladies and gentlemen. We start right away, ladies and gentlemen. I'll be able to share my screen. I'll be able to share my screen. So these are the questions that we are doing. We have these questions here. So explain two challenges that a business entity might face while preparing segmental reports. Now, ladies and gentlemen, let me give you the first challenge that you shall always encounter when you're preparing, in this case, your segmental reports. When you're preparing segmental reports, you will always have a situation with identifying the segments themselves. It's not very easy for you to sit down and say that, hey, this segment qualifies to be called what, to be captured as a segment on my financial statements. There are rules, if you remember. So for example, the segments that you pick, in this case here, we have three segments, for example, A, B, and C. If you have A, B, and C segments, for them to be able to be placed on the face of our statements here, then they should be able to account for at least 75% of the company's total revenue. At least 75% of the company's total revenue. I hope you remember that rule, 75%. You can't just tell us like A, B, C, that A has got 10, or let me use two sectors, that A has got 10, B has got, for example, 20, and then you tell us that other segments are 100. You see, that will be 10 plus 20, that's 30 plus 100, that is 130. So you see now the segments alone are 30, A plus B. That is 30 divided by 130. That's way below 75%. So the segment revenues that you are going to come up with, those segment revenues, whenever you add them, they must be at least 75% of the company's total revenue for us to say that we have got segments. So identifying those segments is normally not an easy thing. That's why very many organizations are not able to do what we call segment reporting. So identification and measurement of segments normally is a big headache. We have number two, allocation of the shared costs and resources. You can't be able to allocate these resources, like for example, resources belonging to the head office. Rent for the head office has been paid. You see, the head office is supporting these segments here, right? What criteria will you use to say that, for example, rent paid, take, for example, like 10% of the rent paid for the head office to ACC with RCM. We're trying to look at costs as our segments. To CPA, 80%. What criteria? Is not a straightforward criteria. So allocating of shared resources and cost and resources is normally not straightforward. You're going to get a challenge there. Then we have issues to do with data accuracy. Ensuring accurate and available data is available for each segment is not an easy thing. Then, of course, we have intersegmental transactions. Managing transactions between segments accurately is a big challenge. Ladies and gentlemen, remember, intersegmental transactions are those transactions where we have like departments serving each other. All right. So assuming we have got two departments here, we have, for example, one department called kitchen, where our staff in this case are eating, right? Kitchen. So this kitchen, of course, will be serving our staff here, like the teachers here. And the teachers, assuming that these kitchen staff are as well doing what here, the students here in the college, then automatically the CPA lecturers are also doing what here? They're also serving these guys here. So anytime we have intersegmental transactions, accounting for them normally is never a straightforward thing. So ladies and gentlemen, just as a quick reminder, amongst those particular points that you have listed, and of course with yours, which ones will you never forget as the major challenges over coming up segmental reports? Which ones in this case will you always remember? Which ones will you always remember here? Yeah, allocation of shared resources and the costs. That one I'll never forget because of what year. That one I'll never forget because of what year, because of the concept of what year, like the head office. Intersegmental transactions I'll also never forget. Thank you very much. Identifying the segments is never an easy thing. Actually, that is the most technical challenge in segmental reports. Ladies and gentlemen, we go from there, we go to IFRS 2, share-based payments, identify 3 types of share-based transaction. So IFRS 2 share-based payments identifies 3 types of share-based transactions. Required, explain the 3 types of share-based transactions in each case, indicating their accounting treatment in line with what year? IFRS 2. In line with IFRS 2. Now, ladies and gentlemen, remember what you're supposed to recall regarding IFRS 2 share-based payments is this. So companies, especially when we are having like startups, at times you may not be having monies to pay your suppliers. If it's a college, I may not be having, in this case here, monies to pay regularly my teachers. So you can agree, instead of me paying you on a monthly basis, let's try to capitalize your wages here. We give you guys shares. So you're going to give you guys shares. So if you're paying through, or rather you're paying your workers, your suppliers, in this case here through shares, then we shall be able to account for your transactions using IFRS 2, share-based payments. Big organizations, they also have these share-based payments, especially whenever they give their senior managers stocks as a way to motivate them. So they're told in this case that we have got these options when our revenues, when our profits reach this level, we shall be able to give you these shares. Then automatically it means that this organization will be able to apply IFRS 2, share-based payments. So if you remember very well, ladies and gentlemen, under share-based payments, we have 2 major methods of settling the payments. Number 1 is what we call equity settled. Equity settled. So under equity settled, for sure, we shall end up giving them what here? Giving them shares. Equity settled, we shall end giving shares. And then number 2, we have what we call cash-based, or rather cash settled. Cash settled. So the cash settled, listen, we'll tell our senior executives that, you know what, you guys, if, for example, our share price will hit 30, we are Safaricom. If our share price will hit 30 shillings by the end of the year, then we shall be able to give you cash of 1 million, each one of you. Cash of 1 million, each one of you. So you see, in this case here, we are going to give these guys here shares. We are going to give them cash, but this cash that we're giving them is based on a share price. It's based on a share price. So I hope you're able to see the difference. We have what we call equity settled, and then number 2, we have what we call cash settled. Are you able to see the difference? Are you able to see the difference between the two? Are you able to see the difference? Under equity settled, we shall give you shares. Under cash-based, we are going to give you cash, but based on the performance of the shares. And then, of course, lastly, we have what we call the hybrid system. So to understand how we do the accounting, I would want us, ladies and gentlemen, to simply come and look at this one here. So equity settled share-based payments. Equity settled share-based payments are transactions where an entity receives goods or services as consideration for its own equity instruments, e.g. shares or share options. The entity issues equity instruments to the counterparty as part of the payment arrangement. Accounting treatment, the fair value of the goods or services received is recognized as an expense in the income statement over the vesting period. The corresponding equity settled share-based payment is recognized as equity. The case in question here will be like, for example, the services offered to RCM by lecturers that we are not paying. So of course, those services, valuation of that service, that automatically will go to the income statement as an expense. And then of course, as we give them shares, what we do, we shall be able to credit our share capital. So we are debiting expense, ladies and gentlemen. And then at the end of the day, we credit ordinary share capital because we are giving them shares. We are giving these guys shares. All right. Then we go to cash settled. Under cash settled, the share-based payments, ladies and gentlemen, these are transactions where an entity acquires goods or services by incurring a liability to transfer cash or other assets to the counterparty, usually an employee. The liability is settled by delivering cash or other assets to the counterparty. But again, the cash you're going to deliver is normally based on what year? Is normally based on the performance of the shares. Performance of the shares. If it's only based on performance of shares, then we can't talk about that under IFRS 2. The accounting treatment, the fair value of the liability is measured at each reporting date, and any changes in the fair value are recognized in the income statement. You're going to debit still the expense. The liability is remeasured until it is settled, and the amount paid is recognized as a cash settlement of the share-based payment. So, ladies and gentlemen, please remember that here we are going to pay cash at the end of the day. So in short, to simplify this, we shall be debiting the relevant expense account, and then we credit what year? Cash. We credit cash. Now, there is something that is very, very important. Now, ladies and gentlemen, remember, we have this cash settled. We have, in this case here, equity settled. Under equity, we are giving away ordinary shares for this liability to be extinguished. So now how do we account for this? We debit expense, we credit ordinary share capital account. For cash settled, the fine we have, in this case here, we have a liability which we want to extinguish. But this liability, we are extinguishing it. Remember, these employees, we have what we are liable to them. We've made a promise to them. We must provision for this. We've told them that in the third year, for example, are you having worked for us for 3 years? And then, of course, the share price will be like this. We shall be able to give you, at the end of the day, at the end of those 3 years, we shall be able to give you cash, but based on the performance of the share price. So when that happens, then we will be able to debit an expense, and then we give you cash. So we credit cash or cash at bank, something like that. And then, of course, on a hybrid, ladies and gentlemen, we give an employee a chance of making a choice. Under this hybrid, we give you a chance of making a choice. So should an employee choose, for example, that they want shares, then you know what to do. Debit expense, credit ordinary share capital. If this ninja chooses, in this case here, chooses to go with the cash, you know what to do. So I think that question, we have been able to do some justice to it. Given that discussion, if they bring that kind of a question, you guys will have something to write. Is that the case? Hapo iko sawa sawa. All right. Thank you so much. Ladies and gentlemen, we shall be able to go straight away to the next question. The next question was not a tough one. The objective of International Public Sector Accounting Standards, IPSAS 21, impairment of non-cash generating assets, is to prescribe the procedures which a public sector entity applies to determine whether a non-cash generating unit is impaired or not. Required. With regard to IPSAS 21, impairment of non-cash generating assets, briefly explain the accounting treatment of impairment of non-cash generating assets and how the requirements of IPSAS 21 compare with those of the International Accounting Standards 36, impairment of assets applicable to commercial sector entities. Now, ladies and gentlemen, first of all, whenever they bring up these issues of IPSAS, they're the same with ISS. I'll just remember and even remind the examiner the formula of getting impairment loss under IS 36. Is there any good student who is able to remember the formula of getting impairment loss? Any student who is able to remember the formula of getting impairment loss? Car minus RA. You'll never forget that. It's car minus RA. So it's carrying amount minus recoverable amount. I'll have to tell the examiner like that. For both of them, it doesn't matter whether it's impairment loss under IPSAS or impairment loss under IAS, both of them. Anytime they want us to get impairment loss, ladies and gentlemen, we shall be taking carrying amount minus recoverable amount. All right. Carrying amount minus recoverable amount. All right. So then are you able to remind us again, what is your understanding of this RA? What is the recoverable amount? Because at the end of the day, we want to recover these particular monies you have put into these assets. Are you able to remember the choices? I mean, you've got two alternatives here. So remember, this money you've put into this particular asset, you can only recover that money through two ways. Through two ways, yes. Through two ways, yes. Which ways are these? Either you use the machine and get what we call value in using it. VIU, value in using it. Or I sell this. I sell this. If I sell this machine, I'll be able to earn what we call the net selling price. Yep, but is it possible that somebody gets to share that handout with our ninjas there? So in this case here, we will be able to earn what we call net selling price or fair value less what here selling cost. I hope you're able to remember that. So you sell, you'll be able to get, for example, the sales amount, less any incidental cost of selling, what you're calling the net selling price. Net selling price, and then we have value in use. So you compare the two. Of course, you are a prudent investor. If I have a machine, and I know that if I continue holding on to this machine, ladies and gentlemen, I'm going to get 10 million. And if I sell this machine, I'm going to get 8 million. Then I'm a prudent investor. I'll always choose to go by the better option. So the better option there will be the value in use. So for recoverable amount, I'll be able to compare between the value in use and the net selling price, and I'll always work with the higher. So the moment I've picked a higher figure there, I will take that figure to my formula of getting impairment loss, where impairment loss is CAR minus RA. Carrying amount minus recoverable amount. How do we get carrying amount? Carrying amount is also known as the net book value. The one given in the balance sheet, the net book value, the one given in the balance sheet. Now, the question is asking about when you get impairment loss over cash generating unit, what happens? What happens? So when you get in this case here, ladies and gentlemen, when you get in this case here an impairment loss, when we get an impairment loss, we shall always allocate impairment loss to the assets in the cash generating unit. And which asset is going to suffer first? Is there somebody who is able to remember? Which asset is going to suffer first? Which asset will be suffering first? Yes, goodwill, because now you are impaired. We say it even in our lives. Like now at my age, I'm almost becoming impaired. The impairment loss, of course, now as you age, of course, is there, whether you like it or not. It's life, you know. So if you are being impaired, can you really say that you have got any goodwill? Yeah. So in this case here, any goodwill that we have, then automatically that goodwill will have to be extinguished. And then, of course, in the cash generating unit, we have those specific assets that you can see that these are totally damaged. So the specific assets also, they have, in this case here, to be eliminated from there. And then, of course, in the cash generating unit, if now there are any assets that are left with carrying amounts, then, of course, the impairment loss will be shared to those assets, in this case here, proportionately. Remember this thing, you're giving this examiner like a story. You're giving this examiner like a story there. All right. And then now, of course, you'll come and look at this particular word here. You'll come and look at this particular arrangements here. Now you'll come and talk about like impairment loss under IPSAS. These are applicable for public sector entities. IAS impairment loss, it's for commercial sector entities, for private entities. When you start now mentioning like that, automatically now you are on the way to do what you're to pass it. Accounting treatment, of course, those losses are normally debited in the income statement. The losses shall always be debited in the income statement. And then, of course, in this case here, those losses shall be credited to the respective assets that are absorbing the impairment loss. Because you see, like now goodwill, if you had a goodwill of 80 and now it's fully impaired, what do? You debit, in this case here, the income statement. All right. And then you go straight away and credit what here? You credit that goodwill account. So basically, if I were you, I'll just remember this: debit income statement or expense account, and then you credit what here? Assets. You reduce the values of your assets. All right. Now, please let's read the answer because you guys have the answer. Actually, my work should basically to give you like a high level, and then you should be able to go and study on your own. So accounting treatment of impairment of non-cash generating assets under IPSAS 21. Identification of the impairment loss. IPSAS 21 requires a public sector entity to assess at each reporting date whether there is any indication that a non-cash generating asset may be impaired. Indications may include physical damage, technological obsolescence, legal changes, or other factors affecting the asset recoverable amount. Measurement of impairment loss. If there is an indication of impairment, the recoverable amount of the non-cash generating asset is determined. The recoverable amount is the higher of the asset's fair value, less cost to sell, and its value in use. If the carrying amount exceeds the recoverable amount, if the carrying amount is higher, then an impairment loss has to be recognized. If the carrying amount, you're carrying this asset at a higher value, 10 million, and you can only recover like 3 million, then the impairment loss, in this case, has to be recognized. So how do you recognize this? Recognition of impairment loss. You don't even have to like use these specific what-year headlines. So long as you've got an idea, colleagues, it's about having an idea of the whole process. Then you'll be able to get so many marks here. The impairment loss is recognized in the statement of financial performance or equivalent, unless the asset is carried at a revalued amount under IPSAS, another IPSAS, in which case the impairment loss is treated as a revaluation what year decrease. The best thing is for you to remember that this impairment loss, ladies and gentlemen, will be recognized in the statement of financial performance. Remember, we don't talk about what year income statement. No, statement of surpluses or losses, all right? Or simply a statement of financial performance. Then we have reversal of impairment loss. Of course, not many students will be able to remember this, but just generally. If we have, in this case here, we had impaired these assets, and then they start gaining up. There's nothing, in this case here, these things will always come up back. If you are good, prudent businessmen, we have an asset impaired. Next year, we shall be able to have it. Of course, we shall be able to have these things going up. IPSAS 21 allows for the reversal of an impairment loss if there has been a change in circumstances and the recoverable amount of the asset increases. However, the reversal is limited to the amount that would have been recognized as an impairment loss if the asset had not been initially. They're basically giving us a cap. They're basically giving us a limitation. If the carrying amount is 10 million, and then we have in this case here, the recoverable amount is 3 million. So the asset has made an impairment loss of 7 million. So now we are going back to business. The recoverable amount is increasing. The recoverable amount is increasing by time. So you're being told as you're reversing, you can't reverse. You know, somebody will tell you that now this thing now has gained. The maximum reversal will be 7. Don't start telling us in this case that again you will start it now automatically. If it goes, the gain goes more than 7, it means now you use another standard. That is revaluation then. But if it's a reversal of impairment loss, you can only hit some maximum, which in this case here was the total impairment loss that you booked. Now, ladies and gentlemen, those are things that even if we spoke here 100 times. We shall not be able to, like understand 100%. No, right now where we have reached, it's not about understanding 100%. It's about getting concepts that will be able to make you pass and even get what year and even get a distinction. What I'm telling you is that we don't want perfection. We just want 80% and above. The 20% can go to hell. Comparison with IAS 36, impairment loss, impairment of assets for commercial sector entities. Scope. IAS 36 applies to both cash generating and non-cash generating assets. SCISA. You see, IAS 36 is for profit-making companies. Then we have assets which are cash generating and non-cash generating, while IPSAS 21 specifically addresses non-cash generating assets in the public sector. Great. This I can remember in an exam. The IAS 36 being a commercial enterprise standard applies to those cash generating assets and non-cash generating assets, while IPSAS 21 specifically addresses non-cash generating assets in the public sector. The difference in scope reflects the distinct nature and objectives of the public sector and the commercial sector entities. When we have reversal of impairment, both standards allow for the reversal of impairment losses under certain conditions. However, IAS 36 provides more flexibility by allowing the reversal of impairment loss for both goodwill. Even goodwill will be able to get and other assets, whereas IPSAS 21 limits the reversal to the amount that would have been recognized if the asset had not been impaired initially. Let me tell you something. You know, first of all, it's only that they're not coming out very clear. You know, for government, this term called goodwill may not even be there as an asset. You know, government doesn't care. I mean, like, ladies and gentlemen, like Kenyatta National Hospital, you know, Kenyatta National Hospital is a great strategic asset of the nation. The goodwill that KNH has is so high. But have you ever had the government, bragging about it? I mean, every time they're only getting bashes from the public, like they're not, all right? So even having that goodwill for government as an asset will not be there. So in the public sector, we have goodwill. So whenever we are talking of impairment reversals, loss reversals, then goodwill will also be getting something, which of course then the government will not be having a corresponding goodwill on the other side. Recognition of impairment loss. The treatment of impairment losses is generally similar between IPSAS 21 and IAS 36. Both standards recognize impairment losses in the statement of financial performance or equivalent, with a few variations based on specific circumstances or evaluation model applied. Measurement of recoverable amount. Both standards use the concept of recoverable amount, which is the higher of fair value, less cost to sell, and value use. The application of these concepts is similar in assessing whether an impairment loss should be recognized. Ladies and gentlemen, what have you understood best about this impairment standard? IAS 36, I don't always really even worry about what we call IPSAS, because I know how to make the comparisons. Once I've understood IAS 36, how it works, when they tell me to compare, I'll be able to tell them straight away that, for example, in the government sector, we don't have these cash generating assets. If they are there, then they will be under these state corporations. These state corporations which are making profits. Like, for example, Kenya Re, they use IFRS, they don't use IPSAS. They use IFRS, they don't use IPSAS. There are so many things I expect you guys to talk about impairment, because you may not test this question the way it is given here expressly. So many things. And I always remember formulas. The moment I have my formulas here in my head, then I'm good to go. I'm good to go. I will be good to go. Please type something. There must be somebody there who is now bored, given the hour of the morning. I'm so sure there must even be a ninja who is following me, especially a ninja gentleman who is following me from their bed because they knew that this lesson is a theory lesson. There must be a ninja there, and I can see you, how you're placing that phone. There must be a ninja. It cannot be a lady Beklizi. That must be a man. That ninja must be a man. That one I'm 100% sure. And if they are honest, I'm so sure if they are honest, and some ninja can easily tell me here that Mwalimu for sure I am sleeping. Not sleeping, but at least I'm waiting to get that ninja who is going to confess because I am so sure there must be one. Kelvin, are you sleeping? We shall overcome. The IS-36 for both non-cash generating and cash generating activities. All right, Mukua, great. We shall overcome. We shall overcome. I'm waiting to see you guys mentioning those terms because they are very key. Like there is one similarity that both government enterprises and commercial enterprises, whenever they're getting value in use, they shall always discount their cash flows. That's a point of similarity. When they told you to compare, they want you to look at similarities and differences. Yeah, same identification of impairment laws. I don't think this standard you guys have really mastered it the way I would want you to master it, because I've not seen anybody saying impairment loss is CAR minus RA. To get RA, recoverable amount, you draw that thing. It's value in use, and then net selling price. You pick the higher. If in this case here, the carrying amount is higher than the recoverable amount, then there is impairment loss. And when there is impairment loss, in this case here, we have that criteria of apportioning the impairment loss to the various assets in the cash generating unit, whereby in this case here, goodwill will suffer most. Goodwill will suffer most, will suffer first. And any other specific assets mentioned to be badly damaged. So they will go second. And then, of course, ladies and gentlemen, we shall be able to have the other assets receiving their share of impairment loss proportionately. Yeah, proportionately. All right. So in terms of now similarities, we know that, of course, both, like how we calculate impairment loss will be the same for IPSAS, for IAS. All right. All right. One is for public sector difference. The other one is for what your commercial sector. That can easily give me a marker there. In terms of similarity, value in use for both IPSAS and ISS, value in use will be calculated in the same way, discounted future cash flows. Yeah, both they recognize. That's what I like. Both will recognize impairment loss. Ladies and gentlemen, I think we have done justice to that question, which now takes me to the next question, where they want us to discuss the nature and the contents of management commentary in the context of enhancing the usefulness of financial information to the users of the financial statements. So management commentary. Is there anybody who has ever heard of management commentary? Management commentary, anybody who has ever heard of management commentary? Yeah. If you go to any integrated report like the one that I told you to download of breweries, you'll always get, I can even share it here. Very fast, pretty fast. I have it. I have this document. The documents I can't survive without. I would want to become an excellent accountant. I'm not yet there, but I will be there. So I have to read a lot. I have to do so many things. So, then, gentlemen, if you come down here, you'll be able to see, these guys are very good in marketing. Very good. So you'll be able to see our performance here. We have the group chairman's statement, group CEO's statement. We have here, so these are the management commentaries. Initially, under these management discussions and analysis, they used to do like one report signed by like the CEO and the CFO. No, CEO and the chairman. It used to be like that initially. But given now the current developments in integrated reporting, the chairman has to give his own statement, the CEO has to give his own statement, CFO has to give his own statement. The three should be able to really align their statements. The three should be able to align their statements. Now, ladies and gentlemen, I would want us to simply go to this page number 24 and see what is happening here. These pages, are they showing the pages? Yeah. We're almost there. All right. Let's get to see what these guys normally talk about. Let's get to see. You can see like now here they are talking about capitals impacted. Yesterday I told you about capitals. So you can see social and relationship capital. We have natural capital was impacted. We have here, or for each, like if it's material issues, social relationship capital, natural capital. If it's material, I get these material issues, financial capital, social. So they'll be able to give us the 6 capitals. I mean, CPA is very, very practical. So you can see here we have financial, social, natural capital, all of them. You can see like now they're giving us principal risks. Now I'm looking for page number 24. It could actually scroll slowly. Yes. Don't tell me it's not here. Yeah, group chairman statement. From this gentleman, you must be knowing Martin Odur. I can see age is catching up with this colleague. It gives me great pleasure to share with you the strides our company made in the fiscal year 2023. Despite operating in an increasingly tough macroeconomic environment, coupled with geopolitical disruptions, which disproportionately raised our costs and depressed consumer spending, the group remained resilient and delivered a respectable performance. Multiple excise tax increases in the course of the financial year continue to have a lagging effect on consumer spending power, leading to a slower offtake of our products. Amid these challenges, we maintained our strategic focus and agility on delivering value to our consumers and all our stakeholders through executional excellence and operational efficiency. Regional operating environment, these guys will say so many things, how they're supporting the community. So in short, ladies and gentlemen, whenever you get a question on management discussions and analysis, these guys, or rather that MDA or management commentary is very, very similar to integrated report components. Because these managers will be able to discuss about the financial performance. We made these profits in the year, despite a very tough economic environment, characterized by high inflation, characterized by high taxes from Zakayo. All right. But we went ahead in this case here to, post great performance. And it's because of this and this and this. And then, of course, we have here, when it's management discussions, it's about how you would want to project. Of course, if it's management discussions, ladies and gentlemen, you must also come and talk about the future outlook. You must talk about the future outlook. Ladies and gentlemen, whenever you're talking about management discussions and analysis, always assume like you are a manager there. So if you are a manager in that company, you must give the whole world a narrative or a narration surrounding your strategy. What are we planning to do? Because really, it's an opportunity you've been given to bring in more investors, to have your share price at the stock exchange increasing. So you must really be able to show people that we are doing something. You must talk about operating environment. Like right now in Kenya, I can tell you, things are not easy. Things are not easy. You can see like your statutory deductions used to pay like 300,000. Now they are going to almost 500,000. It's like they're doubling. And most, of course, of this statutory is like the company. It is the company that will bear. Like at RCM, things like affordable, you have to see, you have to increase this guy's salary for you to be able to absorb some of those expenses. So it's a tough operating environment. It's a tough operating environment. So whenever, ladies and gentlemen, we are looking at management discussions for purpose of presenting to shareholders, come and tell these guys, you know what? We will not be able to give you these dividends. We have performed very well, but we will not be able to give you these dividends because we are looking at the future. That is why we incurred some capex. These were our cash flows. So you must discuss the performance. You must discuss the cash flow statement. You must discuss the financial position. In the financial position there, you have to extract, in this case, using Power BI. Using Power BI, you get very good graphs. So show these guys that, you know what, we are doing, our capex is growing. Our assets in this case here are growing. And don't, in this case, of course, forget to always mention about what your prospects, especially when you want to reduce the dividends per share for these shareholders. You know, as directors of finance, ladies and gentlemen, in most cases, we have big problems. And this is why I would want to introduce public speaking classes for accountants, because I've never attended really a meeting where an accountant is giving bad news and they did it very well. No. Like more during COVID, when these circles here were struggling a lot, and most companies are struggling a lot, most of the directors were sent home. And it was not because of their making, it was because of this external calamity. But they are not able to speak well. They're not able to convince. Last year, I paid you a dividend of 10 shillings per share, but this year, please, I'm going to give you only 4. You pause a little bit. Wait to hear, of course, in this case here, those guys making noise. Now they're trying to talk to each other at low tones. You'll get one crazy guy even jumping up on the table saying, no, this director is not about, these guys are stealing. And then you come back and tell them, you know what? It's not even about stealing. There are 3 major reasons why you guys have to support us in this thing. Number 1, we have got these prospects. I know everybody loves what we call a bird in hand. In finance, we have what we call a bird in hand theory. You guys are looking at, for example, what can we get today? Fine, you can get this today, but in the future, what will happen? If it's Safaricom, we are going to Ethiopia. Ethiopia, in this case, is a big nation with a big population of 100 million. So you can imagine, like, whatever is being retained behind here, if we invest this thing, the share prices will, you may not get this money here, but trust you me, by next year, maybe by March like that, those of you who want to sell their shares will sell these shares at a double price. So we must be very good in convincing the public regarding our performance using MDAs, management discussions and analysis. So we have here, management commentary refers to a narrative report provided by the management of an entity accompanying its financial statements. It serves as a supplementary document to the financial statements and offers a broader and more qualitative perspective of an entity's financial performance, position, and prospects. The primary objective of management commentary is to provide context, explanation, and insights that enhance the understanding of the financial statements and contribute to a more comprehensive view of the entity's financial health. Ladies and gentlemen, I love these management commentaries because as auditors, as auditors, we're giving an opinion regarding what here financial statements. As an auditor, my obligation is to go through the income statement, go through the statement of financial position, cash flow statement. In this case here, we have what here, statement of changes in equity, and then we have notes to the accounts. But you see, again, as an auditor, you are always told, and these has come severally in your AAA paper, you're also told here, even if it's not your obligation, you must ensure that you go through the management discussions and analysis, the management commentaries, to see whether there is anything that you have been able to have here, which these guys are saying opposite. You must ensure that the management commentaries are well aligned with the financial statements. And these management commentaries, ladies and gentlemen, then, as I've had here, we are going to have them put together, bound together with these financial statements in what we call an integrated report. And they basically, they are going to help us understand the financial statements in a deeper way, in a better way. All right. So then what are we supposed to be looking at? What are some of the comments? What are some of the things you as managers must discuss on these management commentaries? So contents, we have a business model and strategy. Management commentary typically begins with an overview of the entity's business model, strategic objectives. It explains how the entity creates value, identifies key markets and customers. Now you're not going to have like this kind of what here, like a heading. No, it is within your story as the chairman. Within your story as the chairman, you have to give us that. Give us operating environment and risks. All right. So after that, like you saw Martin Odor mentioning something to do with financial performance, you must talk about this. Then from there, you talk about your statements in the financial, in the integrated report, the financial position, the cash flow and capital expenditure, capex is capital expenditure, the outlook and the future what year, future prospects. Now, enhancing usefulness to the users, we want these users to understand the financial statements, So anytime they ask students about these MDAs, many students really do not answer that question very well. Many students don't answer that question very well. MDA is very closely related to integrated reporting because it's about integration. To integrate is to put together. To integrate is to put together. So we are putting things together for everybody to be able to understand these numbers. And remember, who else should be able to do this explanation better than managers? Financial statement preparation is your work. These are the figures that you guys have been able to prepare, so you should be able to come and tell us a story about them. So if you allow me, ladies and gentlemen, because you have that, I'm so sure you'll be able to read even better. I would want straight away to go to the next question, which you'll have to give me a minute, or 3 minutes for me to extract this question here very fast. In those 3 minutes, a great ninja can do something, right? In those 3 minutes, a great ninja can get a cup of coffee. So I want to send you another document. We back now. Colleagues, are we back? Are we back? Are we back? Are we back? All right. So please, there is another set of theory notes there that I would want you to have a look. Or you may have forgotten to share. That's bad, but at least you guys found your way here. You found your way here. So somebody download the handout. In this case here, share it on WhatsApp in both platforms. In all platforms, even the evening, those are our students. And once you do that, please put your thumbs up for me to continue. And get to print that handout. Get to print them, file them nicely, file them nicely, file them nicely. Yeah, Paul has done it. Paul has done it in the two groups. Paul has done it. Morning to Kosawa. All right, ladies and gentlemen. So to come here, ladies and gentlemen, we go to, there's a guy who keeps on taking this speaking language to Arabic. I don't know why. There's a serious ninja here. We're discussing serious things. This ninja is thinking about Arabic language. It can take you places. Now, so continuation of the one that we had there. See, the objective of international public, and by the way, this has 19 pages. So it means that even tomorrow, you're waking up to do this theory. But I trust you me, it is worth every effort. This theory can make you see places that you've never seen before. Don't joke with this theory. So the objective of International Public Sector Accounting Standard IPSAS 9, revenue from exchange transactions, is to prescribe the accounting treatment of revenue arising from exchange transactions and events required. With reference to International Public Sector Accounting Standard IPSAS 9, revenue from exchange transactions, briefly explain how revenue from exchange transactions should be recognized and how the recognition criterion under IPSAS 9 differs from that of commercial sector entities and international financial reporting IFRS 15, revenue from contracts with customers. Revenue from contracts with customers. So is there anybody who can tell me really anything they know about those two things? So first of all, I have to tell you what IPSAS 9 is talking about. International Public Sector Accounting Standard number 9. It talks about revenue from exchange transactions. It is closely followed by another IPSAS called IPSAS number 23. IPSAS number 23, International Public Sector Accounting Standards number 23. So IPSAS 9 is about what year? IPSAS 9 is about revenue from exchange transactions. I'm repeating again, it is a revenue from exchange. Revenue from exchange transactions. Revenue from exchange transactions. These NGOs like the UN, let me look at Catholic Church. Catholic Church in this case is the best example for this. These NGOs, ladies and gentlemen, will at the end of the day be doing some business. Like Catholic does lots of business. Catholic does lots of what your business. These guys have got schools, they've got hospitals, and many other business ventures. So then they will be having two types of revenues. There's the revenue that they get by doing business, and then we have the revenue that they get by not doing business. Where in this case here, they get like blessings from God. Of course, God can't give you like a blessing. No, God will bless you through people. So people come and donate. So see, when they give a donation, like when you give a tithe in church, do you get anything in return? I mean, like tangible. When you give tithe in a church, do you get something tangible you go back with at home? You say today, I've given my pastor 10,000, so I'm coming home with this. Yeah, of course, I know there is grace, but you see, that is now what here? That's intangible. I'm talking about tangibility. All right. All right. So then we have revenue that these guys are raising out of Mater Hospital, etc., even Catholic University, etc., where they're offering services, That revenue will be accounted for under what we call IPSAS number 9, revenue from exchange transactions. And ladies and gentlemen, we have this other revenue that these guys are getting by, I'm afraid to use the word not doing anything. Maybe, I don't know. Like you guys understand, like the donations. You see, they're getting that revenue, but for sure, they're not giving anything in return. That revenue will be accounted for under what we call IPSAS 23, revenue from non-exchange transactions. So I don't know whether I've moved a bit fast or there is somebody who has been able to get a difference between the two. IPSAS 9 is about revenue from exchange when you're doing business. You're giving out some service or goods. That's revenue from exchange transactions. And then we have revenue where you are receiving something and not giving anything in return. Not giving anything in return. So in this case here, IPSAS wants these not-for-profit companies to distinguish their revenues like that. So on the face of the financial statements disaggregation, they want you to disaggregate and tell them, we have this revenue from exchange, 10 million. We have this revenue from non-exchange, 100 million. You know, IPSAS is forward-looking. IPSAS knows that at the end of the day, these churches and the NGOs will be required to pay corporation tax. It will not even take 5 years from today. All these NGOs, churches, etc., like Kenya, I can tell you in terms of tax environment, we are way ahead now. I'm so sure Kenya by the end of this year, churches will be paying corporation tax. Is there anybody who is agreeing with me? Is there anybody who is agreeing with me? Already there is some 5% which is being mooted somewhere, but I'm looking at 30%. And how this will happen is like this. Now they're going to be told, for donations, revenues you're getting for donations, don't pay as tax first. So they'll start like that. Don't pay as tax for that. But any revenue you're getting from exchange, pay as taxes. Pay as taxes. And then, of course, proceed, but what will follow thereafter, after some time, they'll be told even these on donations. I mean, look at, for example, what this mighty man of God, Ezekiel, is doing in Mavweni. I mean, that kind of a guy, you want to tell me that you would not want him to pay taxes? Of course, he's remitting pay and whatever. I mean, the guy is doing great things. He's doing great things. So, you know, ladies and gentlemen, the government is a shareholder in every business. And for that matter, a significant shareholder. That's why they get 30%. So when they have to be a shareholder because these guys are giving us security. Whenever, for example, these churches have got great meetings in town, policemen have to be sent there to at least moderate the crowds and do whatever, right? So every member, including members who are here, please ensure that you're paying taxes. Paying tax at the end of the day means that we shall be able to be stand on our own sovereign, because there are two ways of financing our country. It is either you borrow or equity. So in this case here, taxes, when we pay taxes, we are financing ourselves through equity model. And of course, equity should always be rising like that. I know it's a language people don't want to hear, but it's the truth. So even churches will be paying taxes soon. And at the end of the day, ladies and gentlemen, the taxes that shall be required to pay will be taxes from revenues from exchange transactions. Now, but the question is very great. Let me just share here. Yeah, tulipe ushuru, tujitegemee. Is there anybody who is feeling sad that they are paying housing levy? The objective of internal public sector accounting standard 9, revenue from exchange transactions, is to prescribe the accounting treatment of revenue arising from exchange transactions and events. With reference to international public sector accounting standard IPSAS 9, revenue from exchange transactions briefly explain how revenue from exchange transactions should be recognized and how the recognition criterion under IPSAS 9 differs from that of commercial sector entities under International Financial Reporting Standard 15, revenue from contracts with customers. IPSAS 9. IPSAS 9 focuses on the probability of the economic benefits flowing to the entity and the reliability of measuring the revenue amount. It does not specifically require the satisfaction of performance obligations or the transfer of control, as is in the case of IFRS 15. I will explain. But first of all, allow me to read. IFRS 15 recognition criterion. IFRS 15 requires revenue to be recognized when control of the promised goods or services is transferred to the customer. This involves the satisfaction of performance obligations, which are promises in a contract to transfer goods or services to the customer. Revenue is recognized over time or at a point in time, depending on the satisfaction of the performance obligation. Treatment of exchange transactions. IPSAS 9 primarily deals with revenue arising from exchange transactions, where goods or services are exchanged for consideration with other entities or individuals. Revenue is recognized when there is a high probability of economic benefits flowing to the entity, and the amount can be reliably measured irrespective of the stage of the performance completion. Treatment of non-exchange transactions. IPSAS 9 also covers non-exchange transactions such as taxes, grants, and donations, which may not involve direct consideration from customers. Non-exchange transactions are recognized when the eligibility criteria are met and the amount can be reliably measured. This differs from IFRS 15, which primarily focuses on revenue from contracts with customers involving exchange transactions. Though, remember, now this was split. We have now what we call IPSAS year 23, which covers non-exchange transactions. So this is disregarded. This I should be able to remove it. Now, ladies and gentlemen, please listen and listen to me very well. Listen and please listen to me very well. If you understand this, then you will have understood in this case here the entire concept of what year IPSAS 9 and IPSAS, or rather IFRS what year? 15. Now, I would want somebody to go to wherever, of course, we are doing research. I would want somebody in this case here to give me the performance obligations under IFRS 15. Somebody do your research and post it here. Right now, you can do research from many, many sources, to Google alone. We have the AI. I want somebody to look for me the performance obligations under IFRS 15. Post them here. Post them here. Post them here. Performance obligations under IFRS 15. Contracts with our customers. Because we must have a contract with a customer for us to recognize this IFRS. I'm waiting. I mean, there is something, if we understand, we will not even continue with this session. There is something very special here. For IFRS 15, you don't wake up and say that I'm now going to recognize revenue because somebody has promised me. You're the ones who normally tell me that there is this concept of foreign boyfriend, that somebody from America has promised me, and then you start recognizing. No. Of course, if it is under IPSAS 9, IPSAS is government to government. So long as there is a probability that that money will come, then I recognize. It's easy. It's easy to recognize revenue under government entities. It's easy. So is there somebody who is looking for those performance obligations under IFRS 15? And that has been asked, and there are very few students who are able to answer that question of IFRS 15, especially the 5 criterion model. That door stopped your video. I don't know why you're putting it on, but we shall overcome. All right. So I'm getting very good points really here. Very nice points. For example, please listen here. You're being told by this guy calling himself multiple. Revenue under IFRS 15 is recognized when performance obligations are satisfied in the amount of the transaction price, performance obligations are considered satisfied when a promised good or service is transferred to a customer. This transfer implies, why is it misbehaving this thing now? This transfer implies control of the asset or service in question. Performance obligations can be satisfied and thereby revenue can be recognized. How I wish this I could scroll. No worries, ladies and gentlemen, what we shall do, you will do your research. Of course, our class is supposed to be ending in 3 minutes, but I would really want you to appreciate here, for IFRS 15, when there is a contract signed by both parties, automatically, then there is what here? There is now an obligation from the other party to deliver the goods. All right? Of course, after doing our due diligence, you don't just sign things like that. Right? So in that case, if there is a contract that has been signed, and we can see really that, then we deliver the goods. We'll deliver the goods to the premises of this guy. The guy is in control. The guy has taken possession, for example. Even before possession, the most important thing is like that contract, those documents of invoicing, etc. Then this guy should be able to recognize the revenue under IFRS 15. I don't want to go much into it right now because of also the time. So when we come tomorrow, we should be able to finish this entire, but before we do it, because now you have the handout. Please go and look at all those questions very fast, because now tomorrow it will be high level, high level, high level. So it has been a pleasure, ladies and gentlemen, hosting you this morning as always. I wish you the very best of luck in your workplaces. Put in your best foot forward. Bye-bye. Good day. Good day.